All right, the infamous BRRRR, buy, rent, refinance, or buy, rent, repair, refinance, repeat. And I'm going to be going over why it's really difficult in this market. I'm still doing it in today's market, but the game has really flipped on its head than when this thing was popularized back in the lower interest rates. So I'm going to be going over an actual example of a BRRRR that I've completed. And I've gotten to the repeat part, talk about what I did with the proceeds, what happened with the cash flow, what the process looked like, and here it is. I'm gonna be going over the darker side of the BRRRR that I feel like isn't touched on enough. The BRRRR isn't all rosy and perfect way to infinitely scale a portfolio. It can be a great way to do it, but in today's market, there's some pitfalls. Okay. So this is a 10 unit here in Miamisburg, Ohio that I talked about all over my other videos. But I'm going to be going over specifically what I did to it, what the new value was, my refinance, how much money I was able to pull out, and then what I did with the proceeds and where the traps lay along that road. Here it is, 10 unit. When I bought it, there was a couple vacancies. Everyone's rent was way below market. The roof needed to be changed. A bunch of ACs weren't working. You had tenants that were complaining. The grass wasn't cut. It was in rough shape. These are the photos of when I bought it. So I purchased this property for 560,000. It was listed for 600, but it had been sitting on the market for a while. Interest rates started ticking up, so the market had really slowed down during this time. It was 2023. So I placed an offer for 560. It was originally 550, and then we ended up going back and forth, and then we ended up settling at 560,000. And I really cleaned this property up. It needed work. I used the cash flow that was coming in every month, and instead of taking that and putting it in my pocket, I just kept reinvesting in the property. Every month, I do a repair. When we first bought the property, the roof had to be changed, so that was done right away. This roof was shot. Changed the roof out. Kept rented out the vacant units, repaired them as much as I can, minimally to rent them out, and then as cash flow would come in, I'd repair the exterior. I redid the sidewalk here, was all messed up, pressure washed the building. There was a bunch of interior work that needed to be done, ACs that needed to be replaced. And I just kept investing money in the building, maybe 30, 40,000 over 6 or 8 months, cleaning the building up. And then once the building was cleaned up, I raised rents. It's your classic BRRRR. Rents were $600 a month in a $950 a month market. So I kept, raising rents on the tenants that had been there for a while after handling all their maintenance requests. So once I was done, here's the appraisal when I purchased the property. $575,000. That was the value by this appraisal company for this asset. So 10,000 more than I was getting it under contract for. Kind of made me feel better about the purchase, that I was acquiring something at a fair price. After doing all the work and cleaning it up and spending almost about a year cleaning the building up and fixing it and taking rents to market. Now keep in mind, I bought this building at a 6.75 interest rate. So interest rate had already started ticking up. So I bought it at a 6.75 interest rate, 20-year amortization. My debt service was like less than 3K a month. I think it's 2,900 a month. And then I cleaned the building up, and then after that, this is another appraisal by the same appraiser company for 840,000. So that's the power of forced appreciation. Bought a property. The market was actually pretty flat during this time, so it's not like the market just shot up. This is January 28, 2025, and their initial appraisal was July 7th, 2023. So you're talking like a year and a half. And that's the power of forced appreciation. Within a year and a half in a flat market, I was able to raise the value of this property by 250 plus thousand, more than that. But that's the idea, 270,000. So that's forced appreciation. Now the idea of the BRRRR is you force appreciation and then you refinance the property and pull out all the money you put in, which is exactly what I did. But I want to talk about some of the pitfalls with doing that. And I'm going to go over here in the numbers that can explain better than I can. So if you look here under returns, so I put in 222 for the property. This was down payments, closing costs, and then a little bit for renovation, but most of the renovation came from the cash flow. So put in 222, and then when I refied, I got my 222 back plus 15,262. So I actually did 100% plus cash out refi. If you look here, it's an infinite cash on cash return. It means I've gotten all my money back, and now I have no money in the deal. I got my 222 back. I actually got back about 240 after all was said and done. So I got all my money back out. Great, right? But here's the thing a lot of people don't talk about. The cash flow on this deal was decimated. Cash flow, the rule of thumb for my own underwriting is I typically see cash flow get cut in half from a refinance. So here the property was bringing in 33,000 a year in cash flow. This is net free cash flow after everything, after accounting for vacancy, after accounting for everything, saving for future capex. This is the real net free cash flow. Was 33,000 and change. So about 2,800 a month, 2,900 a month. And then after the refi, it dropped to 17, which is 17,000 a year, which is about, what is that? 1,200, 1,500. So the cash flow gets cut in half. And I didn't buy this property by myself. So I bought this property with other people. So each went from making, 1,000, 1,500 a month to we're each taking home like $600, $700 a month. So this went from being something that actually helped me with my monthly expenses to something that is pretty much, just, making car and insurance payments on my end. So the money comes in, it helps out, but it decimates the cash flow. So I need to do 10 of these in order to where the cash flow is at a point where I can actually, it makes an effect in my daily life versus maybe two of these or three of these without refinancing. So by refinancing, you destroy your cash flow, you cut it in half. But now I have 240,000 that I can go and reinvest in another deal. Maybe get another one of these. I ended up buying a retail center with this money. But the idea is you can take the capital and do it again and again and again. But you got to be careful. Less and less people are able to pull out money or pull out 100%. So this one I had to do a 71% LTV. I couldn't go up to 75 because the DSCR, the debt service coverage ratio, was a constraint. So very quickly, for those who don't know what a DSCR is, the bank will only let your monthly payment reach 1.25 your net operating income. So here is my net operating income right here. So the maximum that the bank will let the debt service, the annual payment go to was 52,000. Okay, so the property's bringing in 70,000 a year after all expenses, and then my mortgage annually is 52,000. And that's where you get that net free cash flow. So a lot of people romanticize the BRRRR, but the reality, especially those that are doing it on single family and smaller deals, you almost take your cash flow to zero. And if your expenses, let's say I have to do 3 or 4 ACs that year more than I was expecting, I could be zero cash flow. I had a tenant leave just recently actually. So I did this refi and then the tenant left and now I'm essentially breaking even every month until I fill that tenant back up. So that cash flow, that 800, 1,200 a month cash flow is now only 200, 300 a month that I'm splitting with my partner, and we're essentially breaking even on the property until we fill that unit back up. So that's what's really going on here with the BRRRR. You decimate your cash flow. You're constricted by DSCR. This was actually a good deal because I was still able to pull out 100% of the money I invested. There's a lot of deals now where I'm only pulling out 90, 95, 80, 85, 70. So it really depends on, how good the numbers are in the deal and how much you want to hurt your cash flow. I'm actually purposely pulling out less money so I can keep the cash flow strong. So it's a balance. It really depends on where you are in your life. When I first got started, I would 1031 everything. 1031, you literally zero out the cash flow, you no longer own the property. Or you refi where you decimate your cash flow. But the point is, like, the BRRRR still works, but you got to keep in mind what you're doing. If you're looking for cash flow, if you're looking for immediate cash flow, the BRRRR might not be the best way to do it. For context, it took me, a year and a half to do this deal. And let's say I did this deal by myself, okay? It took me a year and a half to do this deal. And I got my income to 17,000. And let's say I wanted to get my income to 10,000. Probably means I was going to have to do this, 6 more times? Yeah, 5 or 6 of these in order to get to 100,000 a year in net free cash flow. And it took me a year and a half. So we're talking comfortably, let's say about 10 years of doing deals like this, which this deal's a home run. So I'd have to do 10 home run deals in order to get to 100,000 in income. Or I could do 3 of these without refinancing to get to that 100,000. But at the end of the day, I'd own 10 of these properties versus 3 of these properties. And as rents increase over time, I pay down the debt. In a longer period of time, you'll make more from the BRRRR than you would from just buying these assets stabilizing them, and holding. So it really depends on what your goals are. You're looking for equity growth and you're looking to do more deals and really build a portfolio, or are you looking to have, a smaller portfolio that's cash flowing aggressively where you're making a lot of money? So it's really a balance. When people ask me what am I looking for, I'm still in the capital growth mode. So I'm still doing these BRRRRs, but there's going to be a day where I stop refinancing and just start holding the assets, taking the cash flow, and then only refi when it makes sense, when interest rates dropped. So for context, I actually refinanced this. The interest rates went up. I had a 6.75 interest rate went up to 7.25, but it gave me access to $237,000 of tax-free liquidity that I went and I put into another retail BRRRR that I was able to do. And I'll have another video about that deal. I'm getting ready to refinance that one as well. Coming up soon. So it's not all sunshine and rainbows. You got to run your numbers. How much am I going to be able to pull out? What's my cash flow going to be after debt service? You have to run the property really lean, especially after the refi, to make sure that you're cash flowing anything at all. So that's the reality with the BRRRR. It's still a good system, but there's actually quite a bit of pitfalls when it comes to it. Rule of thumb: your cash flow is going to get cut in half. You may be refinancing into a higher interest rate environment, and then you're probably going to be going lower LTV. You can't always run the numbers at 75% cash out refinance because you're going to be limited by that debt service coverage ratio. I hope you guys enjoyed the video. I'm going to be coming out with more videos here about my journey as I build a multi-million-dollar portfolio, and eventually I want to get to $1 billion assets under management. I know it's going to be a long journey, but like, subscribe, and follow along. Catch you guys on the next one.